The market is currently closed. The last reported closing price for Nuburu Inc. BURU on the NYSE American Exchange was $0.40 at 4 p.m. Eastern Time on October 25, 2025. That price represents a significant surge of 17.27% from its previous close, an incredible move that speaks less to its legacy blue laser technology and everything to a new, aggressive corporate strategy that's completely resetting investor expectations. Most investors who know of Nuburu Inc. probably still associated with high-power blue industrial lasers used in welding and 3D printing, a niche but technically fascinating area. That was the established narrative, the expectation, a small-cap, pre-profit industrial tech company battling much larger players like IPG Photonics or Nlight in the laser space, constantly managing cash burn and facing very real questions about its long-term viability, especially after the loss of some of its core patent portfolio through a foreclosure event earlier this year. The reality, however, is that this recent stock movement and the massive trading volume that accompanied it, hundreds of millions of shares traded, many times its average, isn't about lasers anymore. It's about a dramatic, nearly overnight pivot into the defense and security technology sector, specifically in drone systems and operational resilience software. This is the unexpected insight. The stock is trading not on its current balance sheet or its traditional business, but on the future potential of a newly formed subsidiary, Nuburu Defense, and a frantic series of strategic acquisitions and joint ventures, turning the company into an almost entirely different entity right before our eyes. The high volatility and the recent spike are directly tied to the announcement just a couple of days ago, on October 22, 2025, regarding a strategic framework agreement to form a controlling interest joint venture with Maddox Defense Incorporated, focused on developing next-generation drone technologies for NATO and commercial use. This isn't a small side project. The market potential for the NATO UAV defense market alone is estimated in the billions annually, and the joint venture is targeting approximately $100 million in annual revenue by the end of 2028. This is a profound departure from the company's sub-million-dollar trailing revenues and is the core reason for the 17% jump. It's the market repricing the stock based on this new, high-growth, high-margin defense tech narrative. The trading floor's reaction is understandable. You're swapping a slow, capital-intensive niche industrial business for a potentially fast-growing defense tech integrator. This creates a tension between the old, low-value expectation of a blue laser company and the new, higher-value reality of a defense contractor. But the drone deal is just the latest piece in this aggressive transformation. Over the last 2 months, management, under its new dual CEO structure, has been rapidly executing a plan to build out this defense and security hub. In September 2025, they completed a $12 million public offering to fund this transformation, an essential move to provide capital for acquisitions and stabilize its precarious financial footing. Then came the announcement on October 7, 2025, of a binding agreement for Nuburu Defense to acquire the Italian software firm Orbit, SRL, a SaaS provider specializing in operational resilience. This is a crucial detail because it adds a software component, a sticky, high-margin, scalable business to the hardware focus of the drone joint venture. The market needs to grasp that Nuburu isn't just buying companies, it's acquiring capabilities that fit a very specific, high-demand vertical. The defense sector demands secure, resilient systems, and the combination of drone hardware and specialized software, particularly for European and allied customers, suggests a far more strategic vision than a random string of acquisitions. The expectation was that a company fighting for its NYSE listing compliance would be focused on austerity. The reality is they're pursuing aggressive, financed growth. Let's not overlook the market mechanics here. When a microcap stock like BRU makes a dramatic shift and announces large potential contracts, even if those revenues are years out and based on non-binding agreements, it attracts a specific type of investor. You see a surge in volume because retail traders and smaller institutional players, often those who use platforms like Robinhood for quick trading or who practice self-investing on their individual brokerage accounts, are piling in, chasing the momentum. The high trading volumes show a strong speculative interest. The stock's price movements aren't smooth. They're characterized by massive daily swings driven by news headlines and market sentiment, rather than quarterly earnings or balance sheet fundamentals, which remain weak. This kind of volatility is a double-edged sword. It offers explosive potential returns, but also carries significant risk of equally rapid declines if the deals fall through, or if the company fails to secure the necessary financing or regulatory approvals for their aggressive acquisition schedule. Investors looking for stability, perhaps in Fidelity's wide array of Fidelity mutual funds, or through a risk-averse tool like the Schwab Intelligent Portfolios, would likely steer clear of this kind of dramatic swing. This stock is currently a playground for active traders, those performing online investment who are comfortable with the high-stakes world of microcap momentum plays. The operational focus of the historical Nuburu, the one that used to be the only story, was the development and manufacture of blue industrial lasers. Blue light is absorbed much more efficiently by highly reflective metals like copper, aluminum, and gold compared to traditional infrared or green lasers. This efficiency is critical for modern manufacturing, particularly in the rapidly growing fields of e-mobility and energy storage. Think battery manufacturing and complex electronics. Their original products like the AO150 and the BL250 delivered a high-power, high-brightness solution that promised faster, higher-quality, defect-free welds. It was an innovation that technically solved a major manufacturing bottleneck. However, the commercial execution was slow, the R&D costs were high, and the transition from a specialized technology to a scalable, profitable product line proved difficult. Older financial reports confirm a pattern of continued net losses, negative operating cash flow, and a need for external financing to sustain operations. The past performance provides the anchor of reality that the new growth narrative is trying to sever. The old story was of brilliant science but struggling business. The new one is of aggressive M&A and a focus on government contracts. Now, looking ahead, the future of Nuburu Inc. is entirely dependent on the successful execution of its transformation plan. The company is essentially trying to transform from a niche equipment maker into a diversified defense and security solutions provider in real time. This is a massive undertaking, and the market's enthusiasm is based on several catalysts and risks. The primary catalyst is the finalization of the drone joint venture and the successful closure of the Orbit SRL acquisition. If these materialize as promised, with the projected high revenue and EBITDA from the acquired entities, the stock could see further substantial moves. Management has also hinted at more acquisitions, which will keep the story alive. The continued focus on NATO and allied customer contracts is smart, as government and defense spending tends to be less sensitive to macroeconomic pressures than capital expenditure on new industrial lasers. However, the risks are substantial. The first is dilution. The company had to raise capital, and microcap raises often come at the expense of existing shareholders. The stock's price action shows a continuous struggle against this dilution. Second, execution risk is high. Integrating multiple international tech and software companies and quickly achieving cross-selling synergies is difficult, even for massive firms, let alone a microcap with a new management structure. There is a very recent reminder of this execution stress too. The company received a warning letter from the NYSEAMERICAN for non-compliance regarding a technical disclosure issue. which they quickly resolved, but it highlights the administrative pressure of this rapid, complex restructuring. This is where the tension is most apparent. The expectation is that they will quickly become a legitimate defense tech player. The reality is they are a deeply indebted, low-revenue company trying to execute a complex M&A strategy while simultaneously managing a hostile public listing environment. Investors need to weigh the potential of that $100 million plus annual revenue target against the fact that the company still carries significant liabilities and is operating in a high-risk sector. Do you think this flurry of acquisitions and new business lines will successfully transform Nuburu into a profitable defense player? Or is the market overreacting to the headlines? Comment below with your take on whether this strategy makes Nuburu a long-term hold or a short-term